So here we are, Stephanie McCullough, Kevin Gaines. This is a companion video to our podcast episode number 12 about investing and this fear that a lot of us have about getting it right and, finding the perfect investments, investing at the perfect time. And our message is, guess what? Ain't no such thing as perfect. So just here are some of the visuals that we mentioned during the podcast because we are unable to explain things without a slide. So this is a slide of all the scary headlines, not all, a small subset of the scary headlines that have happened from 1970 to 2019. And I think this is a dollar invested in what? The S&P 500 index, probably, Kevin, right?
Yes.
So what's the big picture message here?
Basically, scary stuff happens. Scary stuff happens all the time. And, at least for the last 50 years, the market still went up.
Yep.
Generally speaking. Yes. I mean, clearly you can see there are some down moves.
Yep.
But so, sometimes headlines, quote unquote, headlines do matter, but they don't matter forever.
And when we talked about the kind of, the short-term market moves being a blip in your long-term picture, right? I mean, look at this piece over here, if you could see around the 2008 period, right? That was a pretty big dip. And yet in the big picture, it doesn't look so bad. So that's what I mean when I say zoom out.
Right. I mean, they even tell you S&P 500 down 46%. And yeah, it went down, but it came back. No guarantee it will in the future. I have to say that for compliance reasons. But, things keep happening. Yep. And I also think it's amusing that the one example that I did give, which was at the U.S. debt being downgraded by the S&P, didn't even make it on this headline.
Right.
Which kind of reiterates the point of just because you think the headline is scary or that it's going to create a certain reaction, no guarantee it's going to.
Yep. Okay. So, next one. This is just to show we were talking about the return of, again, the S&P 500 index since the end of the great financial crisis. So this down here, down 57%. Again, this is just the S&P from the peak in 2007 through the bottom, which was March 9th of 2009. And then since then, up 401% to my birthday, 2020. And then, of course, we did have a significant dip due to COVID. And then this rally since then. And this goes to the end of last year. Any comments on this one before I move on, Kevin?
Well, I would say that it was probably me that assured the market here most recently, because on March 23rd, people realized, hey, it's only 9 months until Kevin's birthday. Let's start rallying. So I'm sure that was the trigger event.
Obviously.
Obviously. No, I don't have an ego problem at all. Anyway, but seriously, what I think is actually interesting comparing to the previous chart, when everybody's trying to talk to you about investment returns or whatever, they pick two random dates. This chart looks entirely different than the previous chart, but it's just, you're talking about a same period of time for the most part.
I mean, 1970 to 2019.
Right, versus 96.
96. Yeah. Yep. So this is zoomed in a bit, right? So the ups and downs look a bit more significant. Right.
So now all of a sudden, the 2008 drop, that looks scarier in this chart than it did in the last chart.
Yep. So back to time horizon.
Zooming out.
Yep. This is the funny chart Kevin mentioned about just zoning out and doing your peaceful meditation on a dock when the markets went down during COVID.
Yeah. I mean, again, look at one of the two previous charts. Those charts had some scary moments. I ain't afraid of no ghosts. Let me look at it. I mean, there's nothing scary here. The market just kind of kept going up and up.
Okay. So the bottom half of this chart is what Kevin mentioned about that Dalbar study. So we are looking at the returns, 20-year investment returns versus actual investors. So here, this yellow one here is what people actually got, right? Most people, the average investor. Okay, my drawing skills are not the best. Over this 20-year period, the average investor got 2.5% per year. And yet the S&P 500 index, the most common measure of large cap US stocks, was up 6.1%. And inflation has been up 2.2% over that year. So investors barely beat inflation. The whole point of investing, as opposed to saving in a savings account, is to beat inflation, is to grow over the long term.
But you did beat cash by
That's true.
0.8%.
So Joe from Jersey, who's been holding cash all this time, hasn't even beaten inflation.
Correct.
He's lost purchasing power over the years.
Right.
All right. So the reason, oh no, my drawings are still there. The reasons that happens is, of course, emotions, right? This is our friend Carl Richards, whom we adore. He wrote the Sketch Guy column in the New York Times for a long time, former financial advisor. So this is what happens, right? We get excited when things are up and the news is good. We as human beings tend to buy. And then bad things happen, scary headlines. We tend to get scared and sell. And of course, his little funny line, repeat until broke.
Yeah. Very few people sold March 19th of 2020. A lot of people sold closer to March 23rd of 2020.
Now remind us why those dates are significant.
February 19th was the high pre-COVID, and March 23rd was the low during the stock market crisis in 2020. So more the same.
And this was our ending message. Investing done right is boring, right? You want to be well diversified. You want to stick in for the long run. You don't want to be trying to make special timing moves and blow the lights out.
Yeah, you don't want this stuff to be necessarily be exciting. Exciting doesn't always mean good things.
That is for sure in the investing world. All right, that's what we got for you today. Thanks for joining us.
Appreciate you tuning in on this one, and look forward to our next episode.